Welcome to today's Explainer. Today, we're taking a deep, institutional level look at a company that touches literally almost every single corner of your life, not to mention the global economy. We're talking about Amazon. We are going to break down an extensive equity research report to see exactly what makes this absolute behemoth pick. The market right now is going through a massive paradigm shift, so we're going to pop the hood, look at the numbers, the strategies, and the valuation to figure out exactly where this titan is heading next. Now, let me ask you a question. When you think of Amazon, do you still primarily think of it as just that place you go to buy paper towels or grab a last-minute gift with 2-day shipping? Because if you do, it's really time to challenge that perception. For years, the market viewed Amazon through this super narrow lens of a massive, low-margin digital storefront. But as we peel back the layers of this research today, you'll see that how Amazon actually makes its money has completely evolved. It's a whole different ballgame now. To really grasp the scale of this evolution, just think about this one number, $70 billion. That is Amazon's trailing 12-month free cash flow. Seriously, let that sink in. This isn't a company just scraping by on razor-thin retail margins anymore. This is a downright cash-generating machine operating at a scale that very, very few competitors on the entire planet can even attempt to match. So here's our roadmap for today's Explainer. Number 1, the everything company. Number 2, the 3 pillars of profit. Number 3, the margin expansion story. Number 4, AWS and the AI era. 5, risks to the empire. And 6, the final verdict. All right, let's jump straight into part 1, the everything company. For years, Amazon just absorbed Wall Street's criticism for showing zero profits, and they did it all because of Jeff Bezos' relentless day-one reinvestment philosophy. But this actually illustrates their true underlying strategy perfectly. It's basically a giant Trojan horse. See, on the outside, Amazon looks like the sprawling, low-margin e-commerce store. But that store, it's really just a delivery mechanism. It's a massive data and logistics engine that secretly feeds and funds their real profit empires, cloud computing and digital advertising. Which brings us to part 2, the 3 pillars of profit. Amazon essentially operates on 3 interconnected pillars. But it's fascinating to see how the retailer illusion is maintained when you just look at the raw revenue breakdown. If you're only looking at the cash coming in the door, retail totally dominates the pie. North America retail brings in 60%, and international retail adds another 22%. Meanwhile, AWS looks like this relatively small slice at just 15%. If you stopped your analysis right there, you'd probably think, yep, it's just a big store. But here is the massive plot twist. When you flip over to operating income, the script completely flips. AWS is the real star of the show. That seemingly small 15% revenue slice, it actually generates over 60% of Amazon's total operating income. AWS is the true financial engine of the whole company. It's the superstar division that's quietly funding the high-growth retail and advertising empire that surrounds it. Moving on to part 3, the margin expansion story. You know how for years Amazon was just pouring cash into warehouses, logistics networks, and massive data centers? Well, the research report makes an absolutely crucial point here. That heavy, cash-burning investment cycle, it's largely over. We are finally entering harvesting season, and you can see it clear as day in their consolidated operating margins. Back in 2022, margins were sitting at a tiny 2.4%. Fast forward to 2024, they jumped up to 8.6%. And looking ahead to 2026, we are staring down the barrel of a projected 10.9% margin. For a company generating hundreds of billions in revenue, this kind of margin expansion creates an absolute tsunami of cash. So what's actually driving all this? Well, the biggest driver, responsible for about 60% of this expansion, is just a shift in their business mix. AWS boasts margins of 35% or higher, and their fast-growing advertising segment is clearing 50%. As those highly profitable segments grow faster than the retail side, it lifts the entire company. Add in CEO Andy Jassy's regional fulfillment optimizations, which are saving a ton on shipping, plus some rationalized headcount and small Prime fee increases, and all of that drops straight to the bottom line. To put that into perspective, let's break down the unit economics for a typical US Prime member, because the numbers are staggering. Between the membership fee, the gross profit on what a member spends, and the ad revenue generated while they're shopping, Amazon pulls in about $499. Subtract the fulfillment and content costs, around $310, and they clear a solid profit of $189 per member. Multiply that $189 by over 200 million Prime members globally, you've got a flywheel generating roughly $40 billion in annual segment profit, just waiting to be deployed. Okay, let's talk about where that money goes in part 4, AWS and the AI era. Amazon is taking that massive cash pile and aggressively positioning its absolute crown jewel, AWS, right in the center of the generative AI arms race. Their strategy covers the entire tech stack, and they are playing it incredibly smart by setting themselves up as the Switzerland of enterprise AI. Step 1, they build their own custom, cost-effective silicon chips. Step 2, they offer a totally neutral platform called Bedrock, where enterprises can use literally any AI model they want, Anthropic, Meta, or Amazon's own models. And step 3, they weave consumer AI directly into the shopping experience with tools like Rufus and Alexa. The genius here is they aren't forcing you into a single walled-off ecosystem. They're just providing the underlying infrastructure for all of them.
And the data proves the Switzerland strategy is working like a charm. In Q1 of 2026, AWS revenue growth re-accelerated to 17%, hitting a mind-boggling $120 billion annualized run rate. According to management, we are past the hype phase. Enterprises are no longer just experimenting with AI, they are actively migrating to actual production. And when it comes time to deploy real, scalable AI infrastructure, AWS is clearly emerging as the preferred platform.
But we have to keep it balanced, right? Let's look at part 5, risks to the empire. Naturally, no explainer is complete without looking objectively at the headwinds. The research outlines 2 totally distinct scenarios here. The bear case, which the analysts assign a 20% probability, assumes AWS growth stalls out to single digits as AI gets commoditized, a macroeconomic recession crushes retail spending, and ad growth just flatlines. Contrast that with the bull case, which has a 30% probability. In this scenario, AWS AI infrastructure explodes to become the industry standard, advertising rockets past $80 billion, and total company revenue crosses an unbelievable $1 trillion mark by 2030. When we translate those scenarios into hard numbers, the risk versus reward becomes super clear. Against a current price of $190, the worst-case recessionary bear market floor puts the downside at about $150, so roughly a 21% drop. But look at the upside ceiling in the bull case. It stretches all the way up to $320, offering a massive 68% gain. Basically, Amazon's fortress-like balance sheet and essential services provide a really robust floor against a remarkably high upside ceiling. Which brings us to our final section, the final verdict. So, where does all this financial digging actually leave us? Well, based on a rigorous discounted cash flow model, the base case target price for Amazon is set at $220. Over a 3-year horizon, that represents a really solid 16% upside from that current $190 price. And remember, that is just the base case. It doesn't even price in the massive exponential multiples we might see from widespread AI adoption. The analysts conclude that right now is an incredibly attractive entry point for patient investors. Why? Because you're looking at a company nearing a 6.5% free cash flow yield, trading near historical lows for a business of this absolute caliber. Even if the retail side hits a bumpy road, the standalone sum of the parts value of AWS alone protects your downside. Overall, the report sees a high probability of 15 to 20% annualized returns over the next few years. Which tees up this fantastic summarizing quote from the research report perfectly. Amazon is one of the few mega-cap tech stocks where you can still get quality growth at a reasonable price. They firmly issue a buy recommendation, pointing out that the broader market is really just underappreciating the long-term durability of AWS and the absolute profit engine that digital advertising has become for them. We've covered a huge amount of ground today, from hidden margin expansions to Trojan horse retail strategies. But I really want to leave you with one final kind of provocative thought. With their highly strategic, neutral Switzerland approach to enterprise infrastructure, do you think Amazon will become the undisputed operating system of the AI economy? I'd love to know what you think about this. Drop your thoughts, your theories, and any questions in the comments below. Thank you so much for joining me for this explainer, and I will catch you in the next one.